Welcome to The Explainer. If you've been following the news, you've probably heard two totally different stories about the US consumer. Are they out there spending like crazy, or are they completely tapped out? The headlines are all over the map, and honestly, it's pretty confusing. So today, we're going to cut through all that noise and figure out what is really going on with the American wallet.
So this is really the big question, isn't it? On one hand, you've got spending numbers that look pretty solid. But then on the other hand, there are some really clear signs of financial stress pretty much everywhere you look. So which story is the right one? Well, let's start by putting the conflicting data right next to each other.
And this slide really captures the whole problem perfectly. On the left, we see a healthy jump in personal consumption, which, is a huge driver of our economy. But on the right, a staggering 2/3 of Americans say they're living paycheck to paycheck. How can both of these things possibly be true at the exact same time? Let's dig in. To solve this puzzle, we've got to start with the numbers that are causing all this confusion in the first place. So welcome to the consumer conundrum. Okay, first things first, let's just make sure we're on the same page with the key term, Real PCE. When you hear that spending is up, this is usually what economists are talking about. And that word, real, is super important. It means it's been adjusted for inflation. So it's not just measuring if we're paying more for the same stuff, it's measuring if we're actually buying more stuff. Think of it as volume, not just price. So even if people are buying more things overall, how are they actually feeling about it? Well, the data says not great. Consumer sentiment actually dropped by 5% in September. Now, this really matters because how people feel about the economy has a direct impact on their future spending. This is a huge red flag that those headline numbers might be hiding something. And here is another really critical piece of this puzzle. The cash cushion for the average household is shrinking. A 10% drop in liquid assets, readily available cash, over the last year and a half, that means less money for emergencies and a whole lot more financial stress for millions of families. So this brings us to the real turning point in our story. If the average person is feeling less confident and has less cash on hand, then who is actually doing all this spending we keep hearing about? To find out, we just have to follow the money. And boom, here is our first big clue. Just look at this split. The top 10% of earners now account for nearly half, almost 50% of all consumer spending in the entire country. That is an absolutely incredible concentration of spending power. The other 90% of the population, all combined, is only spending slightly more than that small group at the very top. And this chart just illustrates the trend perfectly. You can see the three different income groups here. The spending for the highest income group has been on a tear, just staying incredibly strong. But now look at the line for the lowest income consumers. After a little bump, their spending growth has been much, much flatter. So those big aggregate spending numbers we see in the headlines, they're being almost entirely propped up by the wealthiest consumers.
So we know who is spending, but how are they paying for it? And why can't lower income groups keep up the same pace? Well, the answer lies in something we're calling the Great Debt Divide.
This slide tells such a powerful story. It shows that just like spending, the debt picture is really a tale of two different Americas. For high-income consumers, their credit card debt is actually still below where it was before the pandemic, but for low-income consumers, it has now climbed above its 2019 level.
So here's the bottom line. Wealthy consumers paid down their debt and they still have room to borrow, which lets them keep spending freely. Meanwhile, lower-income consumers are relying more and more on debt just to make ends meet, and that puts a hard ceiling on their ability to spend more. This debt gap is really the engine that's powering the spending gap.
Okay, so economic data is one thing, but what does this divided reality actually look like on the ground? Let's take a little walk down the grocery aisle to see the evidence for ourselves. This is pretty fascinating. When budgets get tight, people change what they put in their carts. And the data shows this clear shift toward value. Sales of Hamburger Helper are up almost 15%. Rice purchases have jumped over 7%. I mean, these are not luxury items. These are staples people turn to when they really need to stretch a dollar. You can really see the kinds of trade-offs people are making here. They're swapping out the small splurges, things like ice cream or even fast casual meals from places like Chipotle, and instead they're filling their carts with the basics: rice, beans, boxed macaroni. It's a classic example of trading down to try and manage a squeezed budget. And this number right here is the reason why. This quote, which is based on Federal Reserve data, shows that a 25% price hike over 5 years for the exact same basket of goods, that is a massive hit to any household budget. It's exactly what forces these kinds of difficult choices in the first place. All right, so we've solved the mystery of the divided consumer, but this just raises an even bigger question. If the economy is really running on two completely different tracks, what happens next? And can our usual economic tools even fix a problem like this?
This is such a critical question for policymakers. I mean, standard economic tools are designed to manage the economy as a whole. But what do you do when the whole is basically split in two? Can those tools still work for everyone equally?
And here's the really interesting twist. Research from the Dallas Fed suggests that some of our go-to economic tools, well, they have a pretty limited audience. They tend to only really work to stimulate spending among households that are already more financially stable. For everybody else, they just don't move the needle. So using a tool like this could actually make the economic divide even wider. And so this is where we land. The idea of a single, resilient American consumer. It's basically an illusion. It's a statistical average that hides this deep, deep divide. What we really have is a small, wealthy part of the population with the financial firepower to keep spending, while the vast majority is feeling stretched thinner and thinner. And all of this leaves us with one final, pretty critical question. An economy that is driven so heavily by the spending of just a select few is fundamentally unbalanced. It creates some very real vulnerabilities. And the question we all have to ask ourselves is, how long can a system like this truly last?